The Individual Investor Show.
You want it all, don't you? You share one thing, they all need money. Now let's see if they're brave enough to earn it.
Hello and welcome to the Individual Investor Show. My name is Jenna Brashear, your host for this evening. Thanks again for tuning in. I hope you all had a wonderful week. So we've got some big headlines rocking the markets this week. Tensions at the Ukrainian-Russian border, skyrocketing oil prices, severe storms across the nation, Canadian protests, and of course, COVID lingering in the background. And with big stories around every corner, it's crucial to stay up to date with the latest news, especially when it comes to possible market validity. And of course, on the top of everyone's minds is the topic of risk. Tonight's event is the Individual Investor Show, Improve Your Allocation by Gauging Risk and Ranking Asset Returns. For this week, we're focusing on how to become risk adverse through recognizing your risk tolerance, learning how to use the AAII Asset Class Heat Map, as well as understanding risk-adjusted returns to ensure you're being adequately compensated for the amount of risk you take on when you invest in certain securities. I'm with Charles Rotblut to discuss the AAII Asset Class Heat Map, which helps investors see how various investments in each industry are performing across a 10-year time span. On a similar topic, we chat with Matt Bajkowski on why investors should be cognizant of risk-adjusted returns, as well as be able to understand and calculate the Sharpe Ratio. You won't want to miss out on these two thought-provoking discussions covering everything you need to know about asset class heat maps, as well as risk-adjusted returns. And before we jump in, I do want to preface tonight's presentation by reminding our viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus cannot give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And so without further ado, please sit back, relax, and enjoy our presentation. Hello, Charles. Thanks so much for making time to chat with me today.
My pleasure, Jenna.
I wanted to ask you just a few questions about your newest article in the February AAII Journal, which was the Asset Class Performance Large Caps Lead in 2021, as well as covering a few other things about the Asset Class Heat Map in a little bit more detail. So the first question I have for you is just going over some basics. What is an asset class in relation to diversification?
Sure. So an asset class is basically a big group of similar types of assets. So equities, fixed income, which is bonds. You could have real estate. You could have commodities, which includes gold, oil. And so there's certain types of assets with unique characteristics. So for instance, for stocks, they represent ownership in a business. Bonds, they're debentures. They're debt issued by a company that pays interest. Commodities, generally something that comes out of the earth is a good way to think about, whether it's gold, whether it's oil, or you're talking perhaps corn or other agricultural type products. So arguably, you could say Bitcoin and cryptocurrencies are their own unique type of asset class. And the reason we use those in portfolios or combine them is that each has different risk and return characteristics. So when one asset class might be out of favor, another might be. For instance, as we're talking now, there's a lot of concern about what's happening in Ukraine. If investors are skittish, they might go for the safety of bonds, particularly high quality bonds. Obviously, that's complicated right now by the inflation and interest rate environment, but you can see where there's this trade-off. And we know over time, because different asset classes have different returns and they tend to be in favor at different times, if you combine them into a portfolio, you reduce the overall volatility of your portfolio.
Makes sense. And so at AAII, we have allocation models that help investors, know how to diversify their portfolios. And I just want to get some background on those and what kind of data went into those when we created them in the first place.
Sure. So those models predate my time at AAII. But my understanding is they're originally based on, we surveyed professionals throughout the industry, asking them about allocation suggestions for individual investors. And that's where the basis of it comes from. It actually did come from us reaching out and getting some outside opinions as well as our own research. There's three models. They all vary in a level of growth and portfolio volatility. So our aggressive model portfolio, aggressive model allocation is about 90% stocks, and it's designed to maximize growth. It's designed for an investor who can withstand short-term swings in their portfolio value, and their goal is to maximize wealth. At the other end of the spectrum is our conservative asset allocation model. And as the word says, as the description implies, it's for someone who wants less volatility. It's 40% stocks, 60% bonds. And the idea is this investor is less able to take swings in their volatility swings in the value of the portfolio. And so you need something that's going to be more focused on capital preservation. Hence, it has a big allocation to intermediate term bonds and a sizable allocation to short-term bonds because it's trying to provide more income and less swings in portfolio volatility. The middle, your moderate allocation, strikes of both, of growth and some wealth preservation. It's 60% stocks, 40% bonds. And in terms of portfolio allocation, the 60-40 mix, 60% equities, 40% bonds is a well-established allocation strategy, kind of a middle-of-the-road allocation strategy. Over the long term, it will provide portfolio growth, not as much as the aggressive allocation model, but it will do so with less volatility as well. So for someone who needs long-term growth, but perhaps needs to dampen down the level of portfolio volatility so they can stick with that allocation, a 60-40 type mixture can work well. I do want to point out our 60-40 mixture is a bit different than the traditional 60-40 allocation. The traditional 60-40 is 60% large cap stocks, 40% bonds. Ours actually uses a mixture of stocks, international, small cap, emerging, and we also diversify a little bit on the bond side. So a little bit different mixture than what you would normally see in a very traditional 60-40 allocation model.
And when it comes to diversification, we talk about how to diversify your portfolio with different assets, and we're talking about the allocation models. How does diversification actually reduce risk?
So the whole idea is that you're having different asset classes with different returns, and you're hoping that over time, some of your asset classes will be in favor while others are out. So it's really a balancing type act. For instance, we know if there's a bear market in stocks, bonds tend to do well. If there's an inflationary environment, commodities tend to do well. So what you're trying to do with the diversification is you're reducing your portfolio volatility by having asset classes with different return characteristics. It's also a hedge against your own behavior because if you diversify across different asset classes, and even within asset classes, if you diversify across different asset class categories, say large cap stocks, small cap stocks, emerging market stocks, you increase the odds of being allocated to the right asset class or the right asset class category at the right time. So it provides diversification in both manners.
So when we look at the asset class map, a heat map as a whole, as an investor, how can investors use the heat map to better make better investment decisions, as well as how is that data organized? So how can they read it?
Sure. So the way it's organized is every year we go from best performing to worst performing. So every year the asset class categories that's listed on the left-hand most side of the chart, that's your best performing asset class of the ones we measured. When we look at 7 different asset classes and asset class categories, on the very right-hand side is your worst performer. So left to right, it's best to worst performing. And one of the things, and we color-coded each asset class category so you can actually see how it's positioned in terms of relative performance changes year by year. And we're not the only organization that puts these out, but one of the nice things is that when you look at it, you can see that over time, the best performing asset class category changes each year. And so it's a big reminder that if you're really counting on, oh, this asset class category has done really well, it's a good reminder that, well, it may not necessarily do well the next year. So it can't tell you what's going to happen next year, what's going to happen the year afterwards, but it serves as a good reminder of why you want to diversify instead of concentrating solely on one asset class category. Now, over shorter periods of time, you might see some momentum popping up where perhaps, large cap stocks are doing really well, or perhaps small cap stocks are doing really well, or perhaps something's been out of favor for a little while. So you can see some momentum going on. But I think the big thing is to realize that just because something's doing really well over the last 12 months doesn't mean it's going to continue doing really well or continue being the best asset class performer, because you do have that change in terms of what is doing well.
That makes sense, and we've seen that. Last year the large cap stocks delivered a 28.7% gain. Do we know why this was? And our allocation models, some of them are highly allocated to large caps in general. So just wanted to get a little bit more background on why this happened specifically in 2021.
Sure. And a simple word, tech. We saw the NASDAQ itself do really well. And so it was really these tech heavy stocks that had a very good year last year. Certainly you could also look at perhaps, large cap pharma that did well. But by and large, it was a market that was being driven a lot by tech, particularly, and really just large cap stocks in general in the second half of the year. The economy was opening up. Things were getting better. There were some concerns about inflation doing well. But it is interesting because earlier in the year, we actually saw small cap stocks doing really well. And we still saw it being a good year for small cap value. But I think it really, not going back to the last year, if you look over the last 4 or 5 years, it's really been a giant tech heavy market. And those have done really, really well. And so even when you look at the performance of the S&P 500 over the last 3 or 4 years, you really want to look at your Googles, your Microsofts, your Facebooks, how well they've done. And that's been a big driver of large cap stocks.
And as we talk about, the strongest, just to touch on the weaker asset classes, in your article, you found that intermediate term bonds and short term bonds, as well as emerging market equities, were down last year. What was the cause of this overall decrease?
There's two things. So when you look at the bond side, it's been a combination of interest rates being really low. Investors are favoring stocks over bonds just because the interest rates have been so low. And then obviously over the last year, we've been seeing inflation pick up. So now you have this combination of low yields, and investors are really worried about bond prices because bond prices are inversely related with interest rates. So if you have higher inflation, there's concern about the Fed raising interest rates. Rising interest rates devalue the price of bonds, because if the bond you bought's yielding, say, 1%, and the bonds being issued today are yielding 2%, obviously you want the bond that's issuing 2%, and to accept the bond that's worth paying an interest rate of 1%, you're going to go to that seller and say, I'll buy that bond, but you've got to give me a better price. You got to discount that bond. With emerging markets, it was a combination. Obviously, the pandemics was causing concerns. You certainly had some political issues in certain countries, such as Brazil, but you also saw the dollar being really strong and the U.S. economy doing really strong. And so that pulled some money that might have been looking at emerging markets into the United States as well.
That makes sense. And as a whole, you mentioned, we're looking at the asset class heat map. You mentioned the overall lack of a consistent leader. Can you give us a little bit more background and detail on why you think that was?
Yeah, so every year, depending on economic conditions, depending on interest rates, depending on the macroeconomic environment, you're going to see different asset classes perform differently. And this is why we always tell people, don't just focus on 1 year's returns, because things can change and different asset classes are going to be in different favor. So if you look here at 2021, short-term bond funds, that asset class category was among the worst performers. In 2018, a difficult year for the stock market, that was actually the best performer. And so that's what I'm saying. When you look at this, realize that your leadership's always going to change, but we know over the long term, even though there's shorter term volatility, shorter term swings, over the long term, when you look at your asset allocation, that should be more static than what you see in the year-to-year changes in the performance of different asset class categories, because we know over the long term, being allocated to stocks, particularly being allocated to small cap value stocks, is going to give you a very big return. But over the short term, you're going to set that swing. So I think it's very helpful when people look at this to understand that, but to also set their expectations accordingly. So if an asset class they're allocated to, or an asset class category they hold investment in, hold investments in underperforms for a given year, understand that may just be one bad year and not a sign that you should necessarily bail on that asset class category. Rather, you should understand why you're holding it and what role is it playing in your portfolio. Is it a driver of growth, or is it meant to maybe be a counterbalance against more volatile asset classes?
To build off that, of looking at just the 12, back, or looking at the past 12 months, it could be an issue. And that's why you have to look at the whole picture. Does looking at past heat maps from previous years, such as historical data, help or hurt you in the long run?
I believe it helps. I'm a big believer that the more you understand market history, the more you know about market history, the less likely you are to react, because I think market history helps you set your expectations for what is normal and what is abnormal. And so I think when you look at these heat maps and you see the turnover in asset class categories, and you see the change in leadership, and you also see the change in which asset class categories are not doing well, which are laggards, I think it helps you set the expectations and really helps you understand that I might be allocated to this asset class category, and I might have a big investment in it, but I know every year it's not necessarily going to be the top performer. And there are going to be some years where its performance stinks, but I'm comfortable with that because I realize that's just a normal part of investing. And I realize the long-term advantages of staying allocated to that asset class category are going to benefit me.
That makes sense. And as far as the Prism Academy, we have a section on R, recognizing your risk tolerance and allocation, that is focused on how to calculate your risk tolerance and how to use that knowledge to better allocate your portfolio and reduce risk in general. So how does that tie into what we've learned here today about asset class heat maps and diversification as a whole?
Yeah, I really think it comes down to your ability to withstand risk. And on risk tolerance, in that step, we actually have a worksheet to help you gauging your understanding of risk and what you can withstand. And I think when you look at heat maps, it really kind of gets to that point of, can you stick with the asset allocation? And I think when people look at asset allocations, a lot of times they're focused on return. How can I get the highest return? And, obviously if you have long-term goals, getting a high return is very important. But investors are often better off following an allocation that perhaps produces a little less return, but has a little less volatility, if that's what's required for them to stick with the allocation over the long term. So it's understanding you have this turnover, understanding you have this volatility. If you follow this certain asset allocation, and perhaps it's heavily allocated to stocks, perhaps you're looking at the aggressive allocation. But if you see that, okay, there's going to be periods where stocks are really going to stink up the place, the returns are going to be awful. There's going to be a correction. It's going to be a bear market. Understanding what's your ability to stick with it, because a very heavy stock allocation, or maybe almost full allocation allocating to fully stocks, that'll give you the highest returns, but it'll also have the highest volatility. So look at this heat map and understand, there's going to be this rotation. There's going to be periods where stocks underperform. And maybe perhaps gives you a gut check to ask yourself, can I withstand this volatility? And am I willing to endure this volatility? If the answer is yes, then it is the right allocation for you. But the answer is no, then again, maybe you want to revisit your answers to the risk questionnaire and whether or not you're actually able to withstand this level of risk. And if you're not, that's okay. Just understand that you need to perhaps go with a slightly more conservative approach to asset allocation. And understand the ramifications might mean that you might need to save more for your goal. Perhaps you need to push back further the date of reaching your goal because you have to accept a lower return. But the payoff is, because you're able to stick with that asset allocation, you're still going to have higher odds of reaching that goal when it finally arrives.
That's excellent. And I mean, those are great resources for investors to use, both the asset class heat map as well as the risk assessment worksheets in the Prism Academy. And then I just wanted to ask, is there anything else you wanted to highlight about the asset class heat map or your article, or just reducing risk by diversifying as a whole?
Yeah, I think there's two things there. One, realize that risk and return are separate, and the higher the return you want, the more risk in terms of volatility you're going to have to withstand. So there's always that trade-off. But you're also being compensated for volatility through higher returns. So there is that mix of, financially and psychologically, can you withstand the volatility? If you can, you are going to be compensated for putting up with it over the long term. I think the asset heat maps are always really interesting in terms of looking at. But again, I think going back to this idea is that I think it helps you set your expectations in terms of what can actually happen in terms of turnover, and realizing that just because an asset class category has done really well this year doesn't mean it's going to continue doing well next year, and you can't have this volatility into it.
That's really good to remember. Yeah. And thank you so much, Charles, for sitting down with me and chat with me today about your article. I learned so much about risk assessment, tolerance, diversification, and the asset class heat maps as well.
Great. Thanks, Jenna. I enjoyed it.
Yeah, and just for our members, I'd like to highlight that they could check out the asset class heat map for themselves in the AAII journal. You can visit aaii.com/journal. And if you want to participate, we've mentioned the Prism Academy, talking about risk, allocation, in step 2. You can visit that at aaii.com/learn and plan to get started. So yeah, thank you so much, Charles, and I hope you have a great rest of your evening.
Thanks, Jenna.
Hey, Matt, thanks so much for making time to talk with me today about your article in the February AAII journal, which is called Understanding Risk-Adjusted Returns via the Sharpe Ratio.
Hey, Jenna, thanks for having me.
Yeah, no problem. And I appreciate you making the time to chat with me. I have a few questions. And my first question is kind of just getting a brief understanding of what risk-adjusted returns are.
Yeah, so risk-adjusted return is it's a calculation of the profit or potential profit from an investment, and it takes into account the degree of risk that must be accepted by the investor to get that return. Usually this risk is measured in comparison to a risk-free investment, so typically US Treasuries. There's different methods to calculate risk-adjusted return. Depending on the method used, the calculation is either expressed as a number or a rating. They could be applied to individual stocks, investment funds, and entire portfolios. And they play off the natural relationship between, or it looks at the natural relationship between risk and return. Investors seek the lowest level of risk for a given level of return. And alternatively, they won't take on additional risk unless there's a higher chance of greater return. We do this every day with small decisions that have some basis of speculation. So this relationship of risk and return is essential in finance. And it argues, right, that riskier investments should compensate investors with higher returns, and safer investments should not experience much price fluctuation.
That makes sense. And similarly, I wanted to get a little understanding of what the Trainer ratio and the Sharpe ratio, just because you mentioned both in your article as well.
Yeah. So the Sharpe ratio comes from William Sharpe in the mid 60s. And when you're using the Sharpe ratio, the higher the value, the more excess return investors might expect to receive for the volatility that they're being exposed to for holding that asset. Specifically, the Sharpe ratio subtracts the risk-free rate of return from the average rate of return of the investment you are specifically evaluating, whether that's a stock or a portfolio. Then that difference is divided by the standard deviation of your chosen investment's rate of return. The standard deviation is its deviation from the mean of its return. It's commonly used to measure volatility, and thus riskiness. For instance, if an investment deviates only 3% from its mean on average, it's judged as less risky than an investment with a 20% average deviation. And as far as the Trainer ratio, both the Sharpe and the Trainer ratio use or measure how the investment vehicle you're looking at compensates you for given risk. The main difference is that the Sharpe ratio uses the standard deviation, as I was talking about, and the trainer ratio uses beta. Beta is another measure of volatility, but it's specifically looking at the individual either stock or portfolio compared to the market as a whole, not just looking at its standard deviation of returns.
And now that we have a little bit of background of what the ratios mean and what risk-adjusted returns are, how should investors use the Sharpe ratio to analyze a company before they invest?
Yeah, so Sharpe ratios above 1 are generally considered good. This suggests that the portfolio is offering, offering excess returns compared to its volatility. A portfolio with a Sharpe ratio of 1 might be considered inadequate, though, if its competitors and its peer group have an average Sharpe ratio above 1. But generally speaking, the greater portfolio Sharpe ratio, the better its risk-adjusted performance. If the analysis results in a negative Sharpe ratio, it either means that the risk-free rate of return is greater than the portfolio's return, or the portfolio's return is expected to be negative. And in either case, a negative Sharpe ratio doesn't convey any useful meaning there. So a high Sharpe ratio is good when compared to similar portfolios or funds with lower returns. The Sharpe ratio also can explain whether a portfolio's excess returns are due to smart investment decisions or if they're the results of too much risk. Sometimes a portfolio, specifically looking at a portfolio or a fund, they can enjoy higher risk for a period of time compared to peers. But that additional return is only worthwhile if you're being compensated for it. So overall, the Sharpe ratio was originally developed as a forecasting tool, but it can also be used to look at historical risk-adjusted rates of return. So you could look at it both from a forward and backward perspective there.
That makes sense. And it sounds like that the Sharpe ratio, as well as risk-adjusted returns, it's a good comparison tool if you're like looking at different securities, but you have to say within the industry to get a pretty good accurate score. Is that kind of correct?
Yeah. So the some of the weaknesses there, are its relative value, the total risk, and its Sharpe ratio's reliance on a normal distribution. So yeah, as far as this also gets into level of adequate compensation. As a comparison tool, it's extremely weak when you're looking outside of a similar the same industry, or for a fund of the same category.
Makes sense. And so you have to be careful as an investor. And as far as in your article, you do mention that many investors, neglect to take the time to look at an investment's risk or validity before they purchase. Why do you think that is?
The image in my head, what I'm thinking of is what AAII's founder Jim Clinton called a level 1 investor. So that's someone that's doesn't have an organized investing strategy. So they're driven by impulse and emotion, and you're also being pushed by random observations and advice, and you're in a constant state of flux. Generally, I think the good majority of individual investors at times fall into this category. You know, it's a spectrum. So at different times, I've been a level one investor. But yeah, it's that concept of the level one investor that I'm thinking of there.
I can definitely see that. And as far as as you also mentioned that investors use or should use risk-adjusted returns to see if they are being adequately compensated for the risk that they're assuming when they purchase a security. Can you just give me a little bit more background on this? Kind of like, what do you mean by compensation, and then what does adequate compensation even look like?
Yeah, so compensation right there is just literally returns. And then as far as adequacy, it's as I started before, um, it's adequate based on peers. From a value standpoint, you should be getting better performance from an investment that carries more risk. Um, as we said at the beginning, there's a basic financial kind of behavioral tenet. Um, that investors seek the lowest level of risk for a given level of return, and they won't take additional risk unless there's a higher chance of return. Um, so when that's really what we're looking at for adequacy uh, when it comes to that.
Excellent. Yeah. And as far as the AAII website and for our members, are there any specific tools or resources that investors can analyze or look at in regards to risk-adjusted returns? Or is there any other like tool that can compare securities so that they can know if they're adequately compensated for risk?
Yeah, we have, as I mentioned, you could use the Sharpe ratio for different types. Use it for stocks or funds. We don't have the Sharpe ratio specifically, but we do have risk-adjusted return calculations and tables available for funds and for our stock screens. You can find and for the funds, that's specifically the equity-based funds. You can find that on either the mutual funds page or the ETFs page, each respectively. And then for stock screens, you'll find risk-adjusted return calculations on the risk and return table.
Excellent. And as far as your article, is there anything else you'd like to highlight that I didn't previously mention before?
Yeah, just if I've said orally the formula for the Sharpe ratio, but if you're looking for it written, as a visual reference, that is provided in the article.
Excellent. So a really good resource for members who want to delve into the ratios a little bit and see if they're if they're compensated for their risk that they're taking.
Right.
So it makes sense. Well, thank you so much, Matt, for sitting down with me. I appreciate it. And I learned a lot about Sharpe ratios and trainer ratios and risk-adjusted returns, and I hope our members did too.
Yeah, me too. Thanks, Jenna.
Yeah, and I just do want to mention that for our members, if they'd like to check out the latest issue of the AAII Journal, which is the February 2022 issue, they can visit aaii.com/journal. And I'd like to thank you again, and I hope you have a wonderful rest of your day.
Yeah, thank you. Me too.
Thanks.
Now for a message from our friends at Discover Bank. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner Discover Bank on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Take a look. With Discover, you can earn over 5 times more interest than the national savings average with preferred member rates and pay no fees. That's no fees, period. Plus, no minimum balance is required. You can access your AAII member savings account with Discover Bank from your smartphone or tablet, so it's easy to keep your money moving in the right direction. Open an AAII online savings account to start saving for the future today. Visit aaii.discoverbank.com to learn more. We hope you enjoyed tonight's broadcast. I want to thank Charles Rotblut and Matt Bajkowski for making time to chat with me today. Learning how to diversify your portfolio to reduce risk, as well as ensuring you are compensated for taking on additional risk, are 2 key factors that will help you become an effective individual investor. And as always, please remember to click the subscribe button if you'd like to be alerted of future II shows. You can always catch a replay of tonight's event on our YouTube channel, and make sure to register for upcoming AAII events and webinars by visiting aaii.com/webinars. And if you're an investor on the go and want to catch the II show while driving or going for your daily walk, you can now follow us on Spotify. Lastly, you can view both Charles and Matt's articles in the February 2022 AAII Journal issue by visiting aaii.com/journal. With that, we wish all of you viewing good health, good fortune, and a great evening. Thank you and happy investing.